My first guest today is Rich Friedman, chairman of Goldman Sachs Asset Management and member of the management committee, where he leads the development of the firm's alternatives business. Rich also co-chairs Asset and Wealth Management's private investment committees, including growth, infrastructure, and real estate. And of course, prior to his current role, Rich spent 21 years as the global head of merchant banking division investing. With that, Rich, it's great to see you here today.
Thanks, Anastasia. I'm glad to be here.
It's really wonderful to have you here in the studio to talk about the private equity investing environment. And you're the perfect person to do that because, of course, as I mentioned, you spent over 2 decades in private equity investing in private companies across the spectrum. And so I wonder, what is it that you're seeing today for private equity environment? How is it different from the last 2 decades?
So it's a good question. We get asked it a lot. Because it seemed that 10, 15 years ago, following the financial crisis and where interest rates were really low, it felt like a very conducive period to invest. Debt was very available, and it seemed like we were sort of coming out of a tough period. But and when you look back, you say it must have been an easy thing to make those decisions, which it wasn't. Now we're coming out of a COVID period, and then from the COVID period, there was plenty of stimulus that went on. And now we're looking at much higher interest rates than we really had during that, that 10-year period. So yes, the mathematical equation is different. I actually feel pretty good about the outlook from here because I felt over the last couple of years, we were coming out of this period of stagflation where we're having higher inflation and you really didn't know what was going to go on with the economy. And now I feel as if the economy is at full employment and has been this way for a long time. And I think that's going to continue. I think interest rates are stabilized on the long side at a higher level than people will want. And certainly everyone wants lower rates on the short end. Mm-hmm. But these levels aren't all that different from what I had throughout my career. So I think we're going to be in this period where the economy continues to hum along. And we have to adjust to higher interest rates, but they're not so high. I mean, when I started my career, the prime rate was 17%.
Right. So 4 or 5%.
Doesn't feel that bad, but you would think interest rates should have some effect on the prices paid for companies. And that's what I think is going on right now. There's a little bit of a disconnect between where interest rates are and where multiples are for assets.
That's right. Let's assume that 4 or 5% interest rates are here to stay for some time. And by the way, that's what we had before the financial crisis. And by the way, we did have solid private equity returns during that time. But what about multiples? I hear a lot of concern about the level of valuations. Are they fair? And if we look at some of the transactions that are done, it looks like they have snapped back to pretty high levels, from the 2023 correction. So are private equity valuations fair right now?
Well, you're correct that it seems like there's been a snapback on valuations. It's on a smaller base of deals that have been done, but the prices aren't for the faint of heart. But I think that's not that, I guess it's not that unusual to sort of suspect, okay, the first deals that are coming out, the sellers have to get what they want. So you have to find the buyer really loving the area that they're going into, for whatever the reason is. But there's still, I don't know what the number is, $1 trillion of inventory owned by private equity firms that ultimately has to sell over the next 3 to 5 years. But I do agree that interest rates being where they are should bring multiples down 2 to 3 points. It's not bringing them down 5 to 7 multiple points. We're not going back to those periods. And look, I think if we can get some, lower Fed funds rates at some point over the next 12 to 18 months, I think everyone's going to say, great. But we're not there yet.
Well, you think about the value creation in private equity. Some of it typically has come from financial engineering, which it feels like we really can't count on that anymore because if anything, private equity firms are using less debt. Some of it has come from multiple expansion. From what you're saying, we certainly can't count on that anymore. In fact, we might see some multiple contraction. So what does that leave us with? What levers do you pull as a private equity manager to continue to deliver those hopefully outsized private equity returns?
Something that we started doing, I'd say 7 to 10 years ago is really focusing on buying these platforms. Buy companies that have platforms of businesses, whether it's insurance brokerage or different doctors' practices, whatever you want to look at as sort of a platform that you could add on to through acquisitions. And then the operational improvement side, we've built a very big area, a group of 80 former executives, and consultants under a roof that we refer to as the Value Accelerator. And we assign anywhere from 3 to 5 of them to every company that we have. And we work on the various strategies, whether it's efficiencies and cost improvements, or whether it's growth, pricing, A lot of these companies have the same issues. And the thing that we really got, I think, good at over the past 5 to 7 years is technology. We got to bring these companies more forward to what's currently capable on the technology side. And then the hope for AI, what it can do for the operating efficiencies for companies on both expenses as well as revenues is something that's out there.
I mean, how big of an opportunity set is that? Is that top of mind right now as you think about ways to create value?
I think it's top of mind today. I think the applications today may be on the sales side. It may be on the customer, connectivity side. I don't think we're there yet to point to the operating efficiencies of how we can sort of find cost improvements by lowering the amount of people we have or things like that. I think it's too early days. I think there's incredible hype with incredible success of creating these large language models. But now there's a period of learning how to apply them and use them. The question is should every company have an AI officer? I don't know.
But that's a great point, is that we are in a bit of a trial and error process right now when it comes to implementing AI and hopefully driving productivity. And of course, that's something that you want to do in private markets versus piloting that if you're a publicly traded company. But I guess to that, the question that I get, Rich, quite a lot is, what about the illiquidity premium in private equity? It used to be, let's say, 300 to 400 basis points. What's the outlook going forward? Do you think it shrinks given how many more people are participating in private equity? What would you say to that?
The question has been asked in prior periods as well. And now we have decades, though, of being able to actually look at what the spread differential is between a public market portfolio of 60-40, or a private equity, portfolio, which, has historically had several hundred basis points or more of, premium return. I think it's justified. I think it's warranted. If it's not, I don't think the industry is going to be able to raise capital like we've been able to raise capital, because if you can't earn those kind of returns, and it's much more that it's private, not the fact that it's locked up, but it's much more that it's private, that's what the practitioners are supposed to do. I'm optimistic that certainly the top 2 quartiles, I don't know about quartiles 3 and 4 going forward, because this is an institutionalized business at this point. It used to be a cottage industry where there were 5 of us. Now there's hundreds.
There's a few more.
Exactly.
And that's a great point about the interquartile dispersion, because when you look at large cap equities, for example, there's not a whole lot of differentiation sometimes within managers. But when you look within private equity, especially growth equity and venture, there's a huge differentiation.
Yes.
And then I'm sure you participate in a lot of the secular growth industries as well, like healthcare, like tech-enabled consumer. So I imagine the revenue growth rates that you're seeing for those companies, earnings growth rates are quite a bit better.
We hope so. I mean, we're focusing more on financial services, which is near and dear to our hearts, and we understand it better. Healthcare, tech-enabled consumer, energy transition. We do look for these big sectors where there's tectonic changes going on. I think that's what you hope to get out of your private equity managers is not only find companies that are different and grow faster, but find sectors that may outpace industries overall. So I would say that the energy transition is a very big area for us, and it has been for the last 3-4 years.
Right. So when you think about now within asset management, the big trend, of course, is for private wealth clients to be allocating to private credit and private equity. So what do you say to a private wealth client as your piece of advice to be successful in private equity? What would you be thinking about?
What I would say is that there's a place in everyone's portfolio for this, and you have to figure out your comfort with it, because you're not going to feel as comfortable that you could put your hands on it. Yeah, you could stare at Google stock and you know what it's trading at, or Goldman Sachs stock. But when you own, it doesn't matter what the asset, class is. You just have to. It's put away for long-term, wealth creation, if you will. But you do have to be concerned about, it's not as liquid. I mean, it's truly illiquid. And you won't have the same knowledge or information. But if you have the ability to put some extra capital in for long-term investing, but do it consistently, don't wake up one day and say, oh my God, next year's going to be fantastic. I'm going to triple my allocation.
Right.
Don't do that.
That's not
Don't do that. And don't sit one out because you'd say, oh, this is going to be a bad year.
Right.
You just don't know. We're dealing with the future. It's hard to predict. And once you make your commitments, you've made your commitments. So you're
Right.
better off having a steady commitment and make it the right percentage of your portfolio that you work with your advisors
Right.
on that you're comfortable with. But I believe there's a place for it.
So Rich, the last question is, as you've mentioned, you've been in the asset management industry for a long time and especially focusing on private markets. But as you now chair the Goldman Sachs Asset Management Division, what's the focus for you now? What's different? What's most important in asset management right now?
So there are two different things. So what's most important with asset management for the firm is, and it always has to be this way, it's performance. It has to be, we have to deliver high performance returns to our clients, our partners, et cetera, because the ultimate essence of what David wants us to do is grow AUM. You can't do that by just marketing. You have to do that by delivering excellent returns and
Right.
persistent returns over long periods of time. My personal, it's a little bit of, where I really prefer to spend my time is focusing on the big private equity, the growth capital, more in the equity strategies, because that's sort of been that's been my 40 years in the business.
Right. And obviously, Rich, you talked about the complexity, which is always there. But the way you work through that complexity is you have a discipline, you have a strategic approach. And that's something that certainly makes sense when it comes to private equity and private clients allocating to that. So with that, Rich, you were fantastic to talk to and just the perfect person to dive into all things private equity. So thank you so much for your time and
Great.
insights today. Thanks for joining
Thanks,
us.
Anastasia. Great to be with you.
Thank you.